So here is a very nice long report from the Morgan Stanley Climate Investment or something like this, which put out this report called Understanding Carbon Markets. Came out just now in December 2024, so I'm recording this in the same month. And this is an interactive guide, which means there are lots of links you can click on and get details. But when you take the printout like this, obviously you miss lots of those details, so you want to follow up if you want the details on this. Plus, even the printed version, I'm going to be very brief as usual because I just want to give you the most salient points from the report, and salient according to me, so it's a very subjective choice as well. Okay, so navigating carbon markets, maybe we'll have more than one podcast, probably definitely more than one. So volunteer purchases of carbon credits can play an essential role in helping companies and investors reduce greenhouse gas emissions in line with climate commitments and serve as key mechanisms for funding decarbonization globally. So, keeping the global warming targets in mind, and that we want to go net zero by 2050 and so on, we want to decarbonize the system. We are in a so-called carbon trap, which I have discussed elsewhere. And there will be top-down regulations. There is global framework under the UNFCCC, like the Paris Agreement and the various associated conventions, etc. And then these are considered bottom-up market forces, which are going to also contribute. Obviously, you have to worry about lots of things like transparency, compliance, greenwashing, etc. So we'll touch on a few of these things. So carbon markets, though, have reached a critical point. Work is underway to safeguard that credits market meet criteria designed to ensure that they represent real reductions in emissions and that companies and investors can use them as a part of credible climate strategy. So when I say compliance, we'll see if companies do it because that's profitable for them, or that they are really kind-hearted, good-hearted, worrying about the planet, then it can go in a very different direction than if they think this is a government requirement, so we must do this. The convergence of these two trends, the need for carbon credits that support net zero pathways and the rigor that reliance on carbon credit demands, underscores why carbon markets matter for everyone who aims to mitigate the risks and impacts of climate change. And the other thing to remember here is that Morgan Stanley itself provides, resources for carbon trading and carbon markets, and corporations pay big money for getting their compliance done. So Morgan Stanley is providing this report, but they are sellers of these products as well. So does that matter? Not really, in the sense that we are looking at for just knowledge that we can get out of this one. Okay? Whatever. Oops, sorry about that. I don't know how much noise it made. This guide is designed to equip readers with a thorough understanding of carbon markets, their operation and governance, and recent developments. We hope this resource helps you navigate this critical dimension of the climate finance landscape. Okay? So Carbon Market 101. Then before we dive into the details of the carbon markets, here are a few basics to help explain this corner of the climate finance. Carbon emissions are fungible, which means greenhouse gas emissions trap heat in the atmosphere wherever and by whomever they are emitted. Some, especially CO2 is well mixed. Any additional ton of CO2 or carbon in some form you put in anywhere is going to affect the global carbon, and we know that cumulative carbon is linearly proportional to the warming, so additional warming is going to come from that. So this forms the key principle behind the ability to trade emissions. That's what we mean by fungible. So even if somebody is reducing their emissions over there and you can pay them to offset your emissions, it can work because it's global, right? Economics applies. So carbon trading is a market-based approach to tackle climate change and accelerate the transition to a low-carbon economy. So companies and countries can have comparatively high cost and reduce their emissions, but they can do that by paying another company or country that can do it. As I just said, since it's fungible and global, we can do that more easily in terms of just supply and demand, in terms of the rules of the economics. Two types of markets. There are two types of carbon markets: those that trade emissions allowances, and those that trade carbon credits. Emissions allowances and carbon credits. So permits to emit and carbon credits. The former are often called compliance markets because participants are required to do so by regulation, so they must reduce their emissions, and they are given permits to get it done by buying permits from others or selling their permits if they are low emission and so on. The latter, the carbon credit market, is voluntary market because most entities that purchase carbon credits do so voluntarily, usually in support of climate commitment or claims. So Apple, Google, Microsoft, Amazon, Facebook, they are all doing these kind of trading and offsetting and contributing to renewable energy deployment for their own use, but also because they want to have an image of being environmentally friendly. The other points: net zero ambitions drive anticipated growth. So net in the net zero implies that use of carbon credits to neutralize emissions will be necessary. That cannot easily be reduced. When you want to drive these reductions, then you will need carbon credits. The ongoing and rapid rise in the number of companies pledging to reach net zero by 2050 could fuel substantial growth in the carbon credit market over the next 2 decades, assuming at least some of the companies stick to their climate commitments, which means if there is a way to do this carbon trading to overall meet compliance requirements and head towards net zero, then the investments in the carbon credit market is going to increase, and we'll see some numbers. Use of carbon credits is not a substitute, so we actually have to decarbonize the system. Nearly every corporate climate initiative from the Science Based Targets Initiative (SBTI) to net zero frameworks developed by the United Nations Race to Zero Alliances envision a mitigation hierarchy in which companies prioritize deep reductions of emissions within their value chain before looking to reduce emissions outside of it. So we talk about scope 1, scope 2 emissions, and some include scope 3. We have discussed what they are elsewhere, so I won't go into the details, but actual reductions have to happen. You cannot just trade your carbon credits and find a way to net zero. There is some net reduction that has to happen somewhere. So let's look at compliance carbon markets where you are looking for emissions reductions. So compliance carbon markets are established and run by governments which set standards for their operation and mandate which firms must participate. They function on the principle that firms that put greenhouse gases into the atmosphere must limit and pay for their emissions, right? So you can buy permits and trade permits, meet your compliance in some way or the other. So there are details there in terms of emissions trading schemes that we'll look at a little bit more. Types of emissions trading schemes then. Most ETS markets use a cap and trade model that requires participants to purchase allowances, authorizing the holders to put carbon dioxide equivalent, you convert non-CO2 greenhouse gases like methane and N2O into CO2 in terms of global warming potential. So that's CO2 equivalent. So these emissions into the atmosphere are subject to a set limit by the government. Think of an allowance as an emissions permit. So the governments have committed through their nationally determined contributions to the Paris Agreement, or they may have other motivations as well, health maybe, and hence they want to set limits on CO2 equivalent. Okay, so there are various issues there to worry about. So some ETS markets use a so-called baseline and credit model, which requires participants to meet an emissions reduction target for each compliance period. If a company reduces emissions more successfully than this baseline, it receives tradable allowance credits equal to the excess reduction. So they can then sell it to somebody or keep it for the goal they won't meet in the next period. So baseline, baseline, baseline. So you exceed it, then you earn credits that you can use in some way. Okay. So comparing different types of emissions trading schemes, then I won't go into the details, but basically cap and trade emissions trading and baseline emissions trading. So mechanism to offset emissions limit, caps set for scheme in aggregate, baseline emissions and credit systems reduction set for individual entity, typically by the government. This can be fixed to net zero horizon, or it can be changed over the years. Allowances initially allocated either freely or by auction. Allowances can be traded between entities. Entities must purchase allowances so equal to their emissions, and in the baselines, if emissions are more than the baseline, then you exceed. So baseline emissions and credit system set for each individual entity. So if you exceed the baseline in your reduction, you get credits, right? So as we said before, entities can sell allowances here. Typical cost of compliance higher in the cap and trade, but baseline system will be lower. Emissions limits typically decrease over time for both, and example markets are EU, UK, China here, and Indonesia is doing baseline ETS. So you hope here the market forces will drive faster reduction or make it easier for the market forces to deal with overall reduction in aggregate, but cost will be higher here typically. Okay, type of emissions trading schemes, we already saw that, and prices in emissions trading scheme. Though allowances in every ETS represent 1 ton of CO2 equivalent, allowances in one jurisdiction cannot be used to satisfy a compliance obligation in another jurisdiction unless governments have agreed to link their systems. So even though the CO2 emissions, carbon emissions are fungible in the sense emitted somewhere is the same as emitted here, or removed here is same as removed there, you need agreements across state boundaries to do that, to count it appropriately for you in your country or state, right? So prices reflect idiosyncratic drivers of supply and demand, as well as the different rules governing each ETS, and consequently vary widely among the schemes that we talked about here. Okay. Here are the countries that actually have emissions trading schemes, but some are already in force, like Canada and the US, and surprisingly also here in Mexico, and many European countries, and China, Australia, and some Southeast Asian countries here. And there are some that are under development in the lighter blues here in I suspect Peru, Chile, and Argentina. Brazil is under development. India is under development. Some countries here. My geography is going to be tested. Maybe Iran and Turkey here, maybe, and Japan. And there are a few that are under consideration, like Pakistan. So this is under development in Brazil and under consideration in these South American countries, and there are some here that are under consideration as well. Compliance market prices in US dollars, then EU, UK, California, and South Korea. So South Korea has seen a decline in recent years, maybe something to do with COVID, I'm not sure. So California is counted here, where compliance market prices in US dollars have gone up in tons, per ton of CO2 equivalent, and in EU and UK they went up and have come down as well. And you see that even though US has a emissions trading scheme in place, we are only looking at California because not all states are doing this with as much energy and enthusiasm as California. California tends to march to its own beat, and there is a California effect where other states follow California's example when it successfully works for California for renewables, emissions, trading, emissions trading, and so on. Okay, so what are the effectiveness of compliance markets? So 4% to 15% reduction in global greenhouse gas emissions. What does that mean? Compliance markets have a track record of helping to reduce emissions. That's the number here. A recent survey of academic studies on global carbon pricing, including both cap and trade schemes and carbon taxes, found that such policies have reduced global greenhouse gas emissions between 4% and 15% as of March 2022. That's good news. Jumping ahead, considerations for investors. Primary considerations for investments in compliance markets are availability and liquidity. Right? So compliance, to the extent that it is a regulation that has to be met, investments in carbon reductions for people who want to invest depend on compliance markets. Availability and liquidity. Okay, so there are numbers, 1.1 trillion as of 2023 in terms of the total size of global environmental markets estimated. Much of the liquidity comes from futures contracts traded on the intercontinental exchange, mainly in EU allowances. So there are people who are putting money into it, and there are many investment firms now that offer things like impact investments or green investments and all kinds of things. So returns, of course, matter. Risk differences among structures and rules governing compliance markets create idiosyncratic drivers for allowance prices that correlate weakly with conventional asset classes and among compliance markets themselves. So this is a new deal that people are still trying to figure out. This is one of the reasons why oil companies are saying US should not pull out of Paris Agreement, because Paris Agreement will hopefully drive protocols that will make it easier for everybody, whether it's compliance on carbon or overall reductions in fossil fuel use over time. Oil companies will have a better sense if everybody is complying to one convention like Paris Agreement. If countries peel off and do whatever they want, then the market forces will be very unpredictable for oil companies and everybody else. Hedging, investments in allowances through futures, ETFs, emissions. So, sorry, something traded. I should remember that. Equity traded funds, I think. So obviously I'm not an economist. You know, people complain, why do you do this podcast when you are not an expert? Well, I am exchange traded funds. They are investments in companies that pool money from investors to invest in assets like stocks, bonds, or other securities. So you can think of them as mutual funds, I suppose. So investments in allowances through futures, ETFs, and in limited cases, physical allowances may enable investors to limit their exposure to the risk of compliance costs for portfolio companies. So some economic details there that you can read up, but I'm just giving you a pointer. Carbon credits then, how do they work? Look at the carbon credit basics. The same economics that governs emissions trading schemes applies to the carbon credit market. Expanding the range of abatement opportunities beyond their business's own value chain allows companies with high abatement costs to lower the cost of reducing and eliminating their net emissions, provided the carbon credits genuinely have the emissions impact they claim to have. So investors can see your transparency, credibility, legitimacy in reducing overall emissions and invest in your carbon credits. So this obviously means you have to show additional carbon reduction is being done and not just what you would have done anyways. So that has to be quantified, and emissions reduced or removed by credit must not later re-enter the atmosphere. So some permanency is needed in terms of the emissions reductions, and you have to operate in socially and environmentally responsible manner. So you are looking here at emissions per year over time. So baseline is provided this way, and credit would mean that you are going to exceed the baseline and keep increasing your reductions. So here carbon credit is a reduction in or removal of emissions relative to what would have otherwise happened. Okay, could be investments in your energy sources, reductions in scope 1, scope 2, maybe, and scope 3, materials, energy efficiency, technologies, and so on and so forth. Carbon credit, a verified and tradable certificate representing the reduction or avoidance of 1 metric ton of CO2 equivalent from being put into the atmosphere, or the removal of 1 ton CO2 equivalent from the atmosphere. So you can be emitting and using carbon capture technology if you have distributed sources. Let's say you are an auto manufacturer and you are selling cars, and you are offsetting your scope 3 emission in that sense by doing carbon capture to count for carbon credit. Okay, I'm just saying in a very general way. Types of carbon credits, then the most important categorization of carbon credits addresses how they reduce greenhouse gases in the atmosphere. Carbon credits can either avoid or reduce the release of emissions into the atmosphere in the first place, or remove greenhouse gases that are in the atmosphere already. So type of mitigation can be a reduction, so projects that reduce or avoid emissions being released into the atmosphere. So it could be deforestation under red, so reduced emissions, reducing emissions from deforestation and degradation of forests. Renewable energy cook stove distribution, to date 90% of issued credits are in the reduction and so on, and there are use cases such that can be used in most non-net zero claims, such as carbon neutral plus some compliance schemes. So I'm being brief, but you understand that there is this approach of mitigation where you are reducing or avoiding emissions. Here you are using nature-based solutions, so red plus counts here again, or you put more carbon into the soil, or you plant trees, or you generally achieve emissions impact via nature-based processes, and I have nature-based solutions podcast that you can look up. So to date 40% of issued carbon credits are in this nature-based type of reduction and storage, but again additionality, permanency, etc. have to be verified. So monitoring, reporting, evaluation are always important. Level of implementation, project based, so activities occur at project level, so red plus, etc. 99% of the issued credits here in project based. So just make sure that the numbers are in the way they are being done. Project based basically means you are following specific existing projects like cook stove distribution, renewable energy. You can also do removal in terms of mitigation, where projects that directly remove emissions from the atmosphere are counted. So it could be nature restoration, direct capture, or things like biochar. There are various other methods we discussed under carbon capture. To date, less than 10% of the issued credits are under this category. Use case basically if you think 100% going into this direction, less than 10% are here, whereas here 90%, approximately 90% of the issued credits are in this direction of reduction. Use cases, most net zero standards such as Science-Based Targets Initiative only permit removal credits to neutralize emissions in net zero years. So you set a target and you reach carbon neutral by then. Technology based type of process and storage here, projects that achieve emissions impact via tech based processes. In addition, for removals, projects can either store their captured emissions biologically, so in trees, or geologically, where you pump it into the ground or into the ocean somewhere. Level of implementation, jurisdictional here, activities at regional and national level in terms of the removal. For example, again, jurisdictional RED plus energy transition accelerator and so on. So only about 1% of the issued credits, but seen as an area of growth in the coming years. Okay, so I will stop soon, depending on how long we are becoming, because as I said, we'll need more than one podcast for this for sure. Even though I'm being brief, you can see I'm jumping a lot of the text because the details are there. I'm trying to give you the most salient points, but if you are not satisfied, please go find the report and follow up. Okay, types of credit markets. Then MSCI Carbon Markets has developed its own carbon industry classification to categorize the hundreds of different project methodologies in the carbon credit market. This system provides a comprehensive and detailed view of the entire market by classifying around 30,000 projects across major crediting registries. So those 30,000 projects cover all sectors like airlines, energy, buildings, etc. So we have nature-based, so nature restoration or RED+. This is again reduction of emissions by deforestation or forest degradation. Okay, reduction, removal, and reduction here under RED+. So here you have avoided conversion of grasslands and shrublands, blue carbon and coastal carbon, and peatlands. I've discussed these elsewhere. You also have agricultural land management, improved forest management. Under RED you have general deforestation, high forest, low deforestation, jurisdictional RED+, which means you do it within a country or a state, and so on. Under tech-based, there are non-CO2 gases, and there is reduction, energy efficiency and reduction, fuel switch and reduction. So whether you are removing emissions or reducing emissions, right? So here you have chemical fugitive emissions of methane, landfills emitting methane, and so on. Here you have clean cooking stoves being distributed, efficient distribution of energy, reducing losses, efficient transport systems, energy demand reductions, so that overall energy consumption and emissions are reduced. So those are tech-based. Under fuel switch, you have biofuel, hydrogen and hybrid, so battery and some kind of a fuel switch and other. So renewable energy reduction, carbon engineering reduction with carbon capture or removal with bioenergy, biochar, direct air capture, and so on. Again, being relatively brief, but you get the idea, the kind of carbon credits. And if you look at the carbon credit ecosystem, then you have the ecosystem here, which has intermediaries, project owners, developers, and financiers, standards and registries, validation and verification bodies, which is very important because anybody who is taking credit must show compliance and actual quantification of additionality, permanence, and socially safe, societally safe ways of doing this, etc. Policy guidance bodies exist and end buyers exist. Here you have end buyers of carbon credits are typically companies that retire credits to compensate for or offset their emissions or make a climate-related claim. Registries retire credits used by a company to ensure that emissions reduction / removal the credit represents is not claimed more than once. So retirement has a definition here. Where did I put it? God. Yeah, basically I misplaced it completely. Okay. So we'll come back to it here. Okay. Demands of carbon credits is measured by the number of retirements. A retirement occurs when companies use a credit in support of a climate claim. The number of retirements has hovered around 180 million tons of CO2 equivalent for the last 3 years. And you cannot claim retirement again and again. You can only do it once. As the comparison of retirements and issuance suggests supply has outstripped demand for a number of years, creating a surplus. The total surplus of unused credits in the market rose above 1 gigaton of CO2 equivalent, more than 5 times the annual demand earlier this year. There are some details which I have discussed elsewhere in another context. Basically, when carbon permits were sold, for example, in California and Europe, there were problems because too many permits were sold and their price dropped, which means people can buy permits and emit freely because it doesn't cost them much. So then a base price was set so that the carbon permit prices don't drop below a meaningful level, so that companies are in fact careful about actually reducing emissions when they buy permits. Okay, so these are important considerations. But again, this is some details there that I didn't read, but you get the main points about how the carbon credit ecosystem is set up already and how the market forces and so on are working. So we'll come back and look at how carbon crediting works in practice. Okay, again, remember I'm being significantly frugal in the amount of text I'm reading from the report, but I am still making sure that what I have read allows me to grab the most salient points. I've read it very carefully, and then I report only what is needed for a broad introduction, so that the details I leave behind are really not needed if you just wanted an introduction at this level. But if you feel it's not enough for you, go back to the report and read, please. See you in the next half of this summary.